The COVID-19 pandemic back in the year 2020 saw the hospitality industry dealt with a heavy blow as international borders were closed to slow down the spread of the virus and traveling came to a sudden standstill. Following the introduction of vaccinations and the spread of the virus slowing down in 2021, borders gradually reopened and we saw a lot of revenge travelers booking their trips and the performance of the hospitality industry gradually recovered. CDL Hospitality Trust is one of the hospitality REITs listed on the Singapore Exchange. And in this video presentation, I will be sharing with you some of the essentials you need to know, including an overview of its businesses, its financial performances, debt profile, performances of its properties in terms of revenue per available unit, as well as distribution payout recorded over the last 5 years together with my technical analysis of its unit price movements on a weekly time frame and key price points I've identified. Let's begin. Listed on the Singapore Exchange since July 2006, CDL Hospitality Trust, or CDLHT for short, is one of Asia's leading hospitality trusts with an assets under management of about 3.3 billion Singapore dollars as of end June 2024. As the name implies, it invests in real estate assets used for hospitality, hospitality related, and other accommodation or lodging purposes globally. Currently, its portfolio comprises 20 properties located in the following locations. In Singapore, it has 6 hotels and 1 retail mall in the Claymore Connect. In Australia, it has 2 hotels. In New Zealand, it has 1 hotel. In the Maldives and Japan, it has 2 hotels in each country. In the United Kingdom, it has 3 hotels and 1 residential built to rent currently under development, as well as in Germany and Italy, where it has 1 hotel in each country. In terms of net property income contribution for 2023, 62.1% comes from its properties in Singapore, 21.7% comes from its properties in Europe, particularly in the United Kingdom, Germany, and Italy. 8.3% comes from its properties in Australia and New Zealand, and the remaining 8.0% comes from its properties in Maldives and Japan. CDLHT has a financial year ending 31st December. In this slide, you will find CDLHT's financial performance for the last 5 years between 2019 and 2023. CDLHT's financial results saw a steep year-on-year decline in the year 2020 as a result of the COVID-19 pandemic, where the borders were closed and tourism, both for leisure as well as for businesses, came to a complete standstill. The hospitality sector was one of the worst affected. However, its financial performances recovered in the subsequent years as countries gradually rolled back their strict COVID measures and travel borders once again reopened. Despite of that, its distributable income to unit holders recorded for the year 2023 was still about 35% below the amount recorded in the year 2019 due to a huge jump in finance costs as benchmark borrowing rates rose to a 2-decade high. The management of CDL Hospitality Trust declares a distribution payout on a half-yearly basis, once when it releases its results for the second quarter and another when it releases its results for the fourth quarter. The following table is the hospitality REIT's distribution payout recorded over the last 5 years. As a result of the pandemic, CDLHT's distribution payouts saw year-on-year declines in the year 2020 and 2021 before recovering in the subsequent years. However, its distribution payout for 2023 was still about 37% lower compared to its payout in the year 2019, the year before the pandemic broke out. Apart from financial results, another area of focus whenever I study about a company is its debt profile. And here is CDL Hospitality Trust debt profile recorded between 2019 and 2023. I want to bring your attention to the period between 2020 and 2023, where the percentage of borrowings at fixed rates went on a downward slide from 66% back in the year 2020 to a low of just 52.3% in the year 2023. At the same time, its weighted average cost of debt in the same time period climbed from a low of just 1.9% to a high of 4.2%. Despite of that, however, CDLHT's aggregate leverage has been maintained at a very healthy level of under 40% throughout the entire 5-year period I have looked at. Moving forward, with the US Federal Reserve just announced a 0.5% interest rate cut during the Fed meeting in mid-September, and at the same time signaling another 0.5% interest rate cut in the remaining months of 2024, along with 1% of rate cut in 2025, as well as another 0.5% of rate cut in 2026, bringing benchmark rates down to around 2.75 to 3% come end 2026. CDLHT will be among the first to benefit as it has a relatively high percentage of borrowings at floating rates. The reduction in financing costs could potentially be translated into a year-on-year improvement in its distribution payouts as early as 2025. Moving on, let us now take a look at the revenue per available unit for the properties in the various geographical locations recorded over the last 5 years. One encouraging thing you can see is that comparing the REIT's revenue per available unit recorded for the various geographical locations for 2023 against that recorded just before the pandemic in the year 2019. Apart from New Zealand and Germany, the remaining countries have their revenue per available unit surpassing pre-COVID levels, which is a positive. The following is CDL Hospitality Trust unit price movements on a weekly time frame since the start of 2021. As you can see, it has largely been moving in a range of between $1.07 and $1.30 before going on a gradual downward slide since the start of 2023, where it fell to a low of about 86 cents before rebounding. The following are some of the key price points I have identified, along with the corresponding distribution yields based on its distribution payout of 5.7 Singapore cents per unit in the year 2023. Now, to sum up today's presentation, the steep decline in CDLHT's financial results in 2020 was pretty much in line with the other hospitality REITs as a result of the COVID-19 pandemic during the period. The same can be said for the recovery in the years thereafter as travel borders reopened and both leisure as well as business travel resumed. While CDLHT has one of the lowest percentage of borrowings hedged at fixed rates among the 40 plus Singapore REITs, its aggregate leverage remained at a very healthy level at around 30+% throughout the entire 5-year period I have looked at in this presentation, and a very good debt headroom for the REIT to embark on more yield accretive acquisitions as and when an opportunity to do so arises. Following the gradual reopening of the travel borders, its revenue per available unit in the countries that the REIT has properties in all surpassed pre-COVID levels except for New Zealand and Germany. This is another plus point to note. However, one slight negative to note will be its distribution to unit holders, where the payout for 2023 was still 30+% lower than its payout in 2019. This can be attributed to a huge jump in borrowing costs from 2.2% to 4.2% in the same time period. That said, as the REIT has a rather high percentage of borrowings on floating rates, coupled with benchmark interest rates set to gradually decline from now till end 2026 to around the 3% level, it will be among the first to benefit from any further rate cut announcements, where the reduced finance costs will lead to an increase in distribution payouts. With that, I have come to the end of my presentation today, where I look at CDL Hospitality Trust businesses along with its past 5 years financial performance, debt profile, revenue per available unit, and distribution payouts. I have also marked out some of the key price points based on the REIT's unit price movements since 2021 on a weekly time frame, all of which I hope you find useful. If so, I would greatly appreciate it if you can give this video a like and consider subscribing to this channel so you will not miss out on further postings in the future. Thank you for watching, and I look forward to talking to you again in the next video.